let's talk to our guests. So Russ Driver and Jacqueline Brose. So thank you very much indeed. So the idea of this panel was to look at some interesting funds that have moved out to big discounts, explore the reasons why that happened, why that might change in the future, and whether there's kind of a read across to the rest of the sector. That was the kind of idea of it. To get things going, though, I think it might be easiest if to introduce who you are and what the fund is that you run, please. So we'll start with you, Jacqueline, if you don't mind.
Yeah, no problem. Hi, James. Thank you for inviting us on today. Yes, I'm Jacqueline Brewers, Joint Portfolio Manager of Utilico Emerging Markets Trust PLC, along with Charles Gillings. To give sort of a quick overview of what UEM is a closed-ended investment trust. We've been listed now for 20 years on the London Stock Exchange. We actually just celebrated our 20-year anniversary this month. We have over £520 million under management, and UEM is an emerging markets fund that invests predominantly in infrastructure and utility companies. And so just to give you a bit of a flavour, that can be anything from a listed port operator, airport toll road, water sanitisation company, waste disposal, telecoms, renewable generation. That's just a quick high-level overview. Anything is, like I said, infrastructure, utility focused. UEM, though, we are an incredibly active management team. We are very bottom up. So therefore, we are benchmark agnostic. We're not index driven. We are effectively looking for infrastructure utility companies that we think have potentially been mispriced or undervalued due to market inefficiencies or have been overlooked. So therefore, our portfolio, which is around 70 stocks at the moment, we believe provide investors with the most attractive returns in the infrastructure utility space across emerging markets. And then if you look at actually our performance year to date, over the last 3 years, 5 years, and since inception, UEM has actually outperformed the MSCI EM index. And over the last 20 years, we have provided our investors with a return over 5 times. And our NAV annual compounded return is around 9.1% at the moment. Just to sort of drill a little bit more about this bottom-up approach, I mean, this is the thing that really, I think, differentiates UEM from, say, other emerging market funds, is how differentiated we are. If you look at our country, our sector and geographical split, then you can really see the difference. I mean, about 45% of our portfolio is in utility companies, whereas if you look at the MSCI index, it's mainly financial, sort of those banks, the consumer discretionary. We don't invest in any of those stocks. Geographical sector split wise, I mean, we are overweight Brazil, underweight China. Again, you can just really see how different we are. If you look at why we're so focused on emerging markets and infrastructure utility companies, well, firstly, emerging markets. I mean, look, emerging markets continue what we call the structural growth drivers. There is very positive demographics still coming through. We've got population growth, very mean, low age population still, and also becoming much more educated. We've also got increasing urbanisation, the rise of the middle class coming through, and a lot of these emerging market countries still have relatively strong GDP growth. And all of this is really driving a big drive for infrastructure spend, and that's where we sit. And because at the end of the day, infrastructure, we believe, is essential or effectively the fundamental backbone of any emerging market country to develop. It can't move up the value chain without solid infrastructure investment going in. And if you look across a lot of the emerging markets at the moment, many of the emerging markets that we invest in still lack that adequate infrastructure. I mean, water sanitation, waste disposal, road connectivity, rail connectivity, digital infrastructure investment as well. Again, and that is really what we're playing on. So the investments that we typically tend to invest in are not your greenfield toll road projects, say in India, but more the operational assets. And why the operational assets? Because they can provide us with sustainable cash generation. And also a number of the utility assets which we invest in have concession contracts back in them, which means that they tend to have very stable cash generative returns. And over the years, that has been really beneficial again for our shareholders. It's meant that we as UEM, because 80% of our portfolio pay a dividend, it has meant that we have been able to have a rising dividend over the last 10 years. Our yield is now around 3.7%. So that is a really good positive for our fund as well. But also one question we always get asked from investors at the moment is, how is the portfolio really stacking up against all the sort of, the macro backdrop at the moment and the geopolitical noise? And I love this question because I'm like, really, really well. Because look, a lot of the assets that we're investing in have really strong management teams. The operational performance of these assets are still maintained. They're very domestic driven, regardless of what I suppose Trump is going on about elsewhere. Investment into infrastructure within these sort of countries is going to continue. So at the end of the day, We believe that UEM provides investors with a really resilient investment opportunity. I fundamentally believe that UEM should be a stable investment trust in many investment portfolios.
Great. Thank you very much. Ross, your
Yeah,
turn.
good morning. Great to be with you both as well. Yes, I'm Ross Driver. I'm the fund manager for Foresight Solar Fund, which kind of does what it says on the tin. It is a solar investor based here in London. We were one of the original renewable energy investment trusts that first listed about 12 years ago. I think it's fair to say back in the day then, most of the renewable energy trusts that listed were a bit of a yield play, in terms of we're in an environment of when interest rates were low and about to hit the floor. And then back in, there was a real spread between the yields that you could get off these kind of funds, which were probably on average giving around 4 to 6%, and the sort of real return on gilt rates that was negative. So there's a really good spread there, and this continued for all of us, I think, really for the past decade. You then had what was probably the fastest spike in borrowing costs through central banks at the time of the following the pandemic, and then with the crisis in Ukraine as well. So the gilt rates and central bank costs jumped probably the highest amount that they have since the late 70s. And that kind of disconnect, what that did is really squeeze the gap in terms of the returns between these vehicles that we all know, those of us in the renewable space particularly, and then what investors can get through gilt yields or corporate bonds as well. So I think that's something, because when you look at clearly, I mean, not different to a lot of, as regular listeners, I'm sure James will know, not different to the entire alternative sector here in many ways. I think we look at it and think, again, what differentiates us? Because I think renewables in particular has been quite hard hit in this. We have seen a bit of a re-rating in the recent weeks that I think it's a very timely point to have this conversation, because the question is, where do things go from now? But we look at it as well. We tend to invest. We have changed the mandate of the fund. Originally, it was purely sort of operational and in those kind of cash flows, similar to what Jacqueline was saying before about investing in those reliable operational cash flows for the fund. Because if you're effectively a yield co, that's what you want, and those are the kind of returns that were more deliverable. Since I joined the fund about 4 years ago, we were already on a trajectory to sort of change things slightly to go into a more growth. And how do you do that when you're really investing? We're in solar, we're in battery storage as well, that we think is a market that will absolutely be required here in the UK, but also other geographies such as Spain and across Europe. There's going to be a huge growth in that area as well. But why one sort of, in terms of going further down the food chain into construction, or more latterly we've gone into development of projects as well, and that's really to try to drive the growth in the vehicle as well. So we sort of set things out in a capital markets event that we did last year, notwithstanding the sort of challenges of the macroeconomic background at the moment. But what we're saying to investors is there is an intention there to pivot the strategy slightly into, we will still be looking to give a high quality yield. We have increased our dividend every year since inception of the fund. The fund we do have the majority of the portfolio, I should say, is in the UK. In Foresight, UK is our home market. We benefit from the underlying contracts there. The majority of our portfolio in the UK is legacy subsidised projects under the ROC regime. They have index-linked step-ups in them, and that is one driver that's helped us increase the dividend every year. We have projects we're in Spain as well, where we have long-term fixed PPAs that also give us that level of underlying protection, and we have projects in Australia that have long-term off-take contracts as well. So you get that the core portfolio there that is really about 99% operational at the moment gives you that yield. But we're looking at it, and we think even at NAV we're at about a 7% return on that. And you say, look, for a solid operating portfolio, I know there's been a lot of questions about the valuations of these projects in recent years, particularly with the growth rate. We are in a process of looking to divest of certain portfolios. A year and a bit ago, we sold down part of our Spanish portfolio at a 24% premium to NAV. So we do see what is going on in the secondary markets, and we do think that there is still a lot of value in these assets. It will help to prove it, absolutely no doubt. But on the flip side of this, how do we offer something? If we were trading at NAV, that's about 111 pence at the moment, with a 7% yield, is that still enough for investors at the moment? You can pick it up at the moment, even with the re-rating, for about a 9% yield, which I think for a Standard investor is pretty good with a solid track record and growth there. But I think for the institutional investors as well, what we've been saying is how do we offer that additional 1 to 2% of capital growth alongside this to drive the NAV growth? And what we've really focused on there is looking at development stage. So we've got around 1 gigawatt of development in Spain at the moment, split almost equally between solar and battery storage. The idea being that we can bring through those projects, we can get them to a ready to build stage, or when they're shovel ready, we actually then have the optionality to either flip them, sell them through to other people who want to take them forward to build, or actually build them out, develop them, and then sell them later down. So one of the things that just came out a couple of weeks ago, we put out in a trading update, was we've actually being awarded the rights to capacity for 5 battery storage projects in Spain, which we think is going to be a very interesting market going forward. And that is very much a development play at the moment. We think we get those projects in the next year through to the shovel-ready stage, and they will be worth several times what we've invested in them to date. So I think that's the key thing. It is that balance, and I think a really good discussion to have today is around we're doing that in an environment at the moment where our investors, at least, and I think most in the renewable sector, are looking for a return of capital through either buybacks. We've got one of the largest buyback programs in the market relative to the size of the fund. We've just upped that to now 60 million, and we are looking to pay down variable rate debt. So we're putting the third pillar of that is the investment into development, which is single-digit millions we're doing at the moment. I think there is that point as these discounts start to narrow, and we'll have to see what happens during the summer, really, to that. Do you get to a point where actually you get back to saying, actually, investment in here makes sense again, because you need to invest in these funds for continue to protect the NAV. But I'll leave it there for the moment. Hopefully that was a decent intro.
No, that's great. That's pretty comprehensive, both of you. Thank you very much. I suppose there are some things in this story with the discounts and stuff that are macro driven. They're outside your control. But you've alluded to one there, Ross, which is the interest rates. Given that interest rates, the sort of short-term rates anyway, are coming down, should that now mean that people should be piling back into high-yielding investments? Or do you think that actually works more off the long-term rate, which is sort of creeping up?
Yeah, I think if you want me to sort of address that, because it's something I've got it here on my screen, I look at permanently. For us, and I know with our investors will tend to probably look at us, and this has been changing. We use the sort of 10-year gilt as a benchmark, and I think that's the challenge at the moment. If I look at it sort of across year to date, 10-year gilt is about 4.6%. It's exactly the same place as it was at the start of the year. And it's been bubbling along up and down. It's been said, we hope that there should be cuts in interest rates going forward. Inflation is making that a bit tricky. You can see what's going on in the US with Powell just getting a hammering, being walked around facilities hammered by Trump at the moment. But those cuts are coming, but it's not affecting the gilt rate at the moment. And I think partly that is unfortunately driven by, I think there was some hope that there would be some more reining in from government of costs and things like that, but that hasn't materialised it yet. So a level of Bank of England base rate cuts is baked into that already, and the gilts haven't been dropping, which unfortunately I think for the country as a whole as well means that interest costs on government debt are high as well.
And Jacqueline, this rates in emerging markets, I mean, obviously varies by country, but what's the sort of trend of those? And does that actually influence, do you think, people's perception of the fund?
To a degree, I mean, look, as you note, James, that interest rates are dramatically different actually between the countries. I mean, that we invest in. I mean, you can look at Brazil at the moment. It's got interest rates of 15%. So therefore, the returns that we are looking for, and the valuations that we're looking for are affected by those level of interest rates. But I think it's interesting at the moment. Obviously, we have seen this, I suppose you could say, stalling of rate cuts coming from the US. As Ross pointed out, it's unclear what the inflation data is showing us at the moment. But I think what's been positive for the markets at the moment is actually the disconnect between interest rates and the US dollar. And that's really helped us because we're seeing weakness of the US dollar coming through. And therefore, historically, you've seen, I suppose, some of the emerging market countries like Vietnam, Indonesia, well, not so much Indonesia, but Vietnam and the Philippines, being hesitant to cut rates, even though they were witnessing lower inflation rates, because they didn't want to cut rates to weaken their currency against the dollar. But the weakness in the US dollar has meant that they've actually been able to, I suppose, cut ahead of the US, which historically we've always waited for the US to go first. and then the emerging market countries have followed. But we've actually seen them sort of moving ahead because inflation has become a little bit more under control in those countries. So it's been more of a positive, and I think EM is, as we're seeing at the moment, becoming a much more positive sector finally to
Yeah,
invest in.
exactly. Right, there are actually loads of questions coming through here. So actually, we should maybe take some questions of the audience. So actually, first one is for you, Jacqueline. So how do you decide on what are the right countries or regions to invest in, given that what's going on, the variations between them?
Yeah, I mean, look, at the end of the day, we are very much bottom-up investors. We are looking for very high performance, strong operational performance, and strong management teams of companies or stocks within countries. So the country sort of macro and geopolitical situation obviously does have an impact into how we value these companies. But at the end of the day, it's the underlying performance of that company. I mean, just to give an example, at the moment, we are underweight, I suppose, China. A lot of comments have come, how can what is it looking like on the Chinese outlook? I mean, I suppose everyone's been hesitant on where is China going. It's sort of been sluggish over the last 2-3 years, or coming out of COVID, definitely. And there's lots of reasons for that on the political scale. But I mean, look, the opportunities that we're looking at are companies that, we believe that still be able to perform. And actually, one of the companies we've invested in within China is a company called Sunny Vision, which is a data center. And that is basically playing that AI story growth that we're seeing coming through. Back at the start of the year, we obviously saw the announcement of DeepSeek. I'm slightly cynical. Good timing, just as Trump came into power, but obviously showed the Chinese were flexing their muscles, I suppose, to some extent. And we saw a massive re-rating of the AI sector within China. And we had an investment in there because we believed in the growth of the data centers and AI growth within China, that it would come, irregardless of the macro environment. And that stock has done very well with us. So, yeah, we're bottom up. We do factor in macro considerations and also political considerations. But at the end of the day, we're bottom up investors.
And actually, Ross just alludes to something. So basically, there's been this huge demand for power from AI, which you're seeing it everywhere. And some places it seems to be driving up power prices. Do you think, because we've had this long run of power prices coming down, could power prices be about to inflect again?
I think that's a bit of a challenging one to say. You take that example of data centers, and I've been at conferences speaking to data center developers and things like that. And with the size of the data centers they want to build, if they're up to around a gigawatt or 500 megawatt, they can't get a grid connection for it at the UK at the moment. So it would be driving. I think the smaller data centers and everything that's going to be added will drive those power prices at the moment. I think the one thing you're seeing is that things are steadily still coming down, at least in the curves that we use. We use a blended rate of about 3 of them, but there's wildly differing opinions out there. One will come down to the level at which we are building out. Take the UK, for example, the level at which we're building out generation. I guess the success of new deployment of offshore wind, which will be a serious factor in there as well. The amount you're able to get more solar through too. But there's a lot that needs to be unblocked in the grid. I think the gate 2 reforms, that are going through to clear out a lot of zombie projects in there will be helpful. But a lot of it will come down to electrification. Now we use, like I say, 3 of the power curve providers that are probably in the middle. We know there's another one that's a lot higher, and there's a well-known, should I say, large information provider who's got power prices showing them coming down significantly further from there. So it will go to where is the drivers of electrification. Look, I think absolutely data center demand and things such as that are going to be a key driver of this. You can only see things, as you see even in the last 10 years, more and more of our lives is going to be electrified. There's the much that you don't use, maybe your toothbrush and everything these days. So
Mine's electric.
I mean, you talked to Jacqueline about the digitalisation and the stuff that's going on in emerging markets. Is that going to be a big driver of what you do you think, going forward?
Yeah, partly. I mean, look, we're looking at all sort of different opportunities. We have, I mean, the fund has what we call the 4 infrastructure megatrends, one of which is, digitalisation. But, you obviously see the drive of social infrastructure. I mean, as I mentioned earlier, we've got the growth of the middle class coming through. As people tend to move up into the middle class, there's also demand for energy. You want aircon, you want more gadgets, and you want electric cars. And that's also driving need for infrastructure investment, say toll roads. your demand for goods increases, therefore you have more imports into or exports out of the country. You want more better ports. So there's a number of different drivers, not just the digital infrastructure growth that we're seeing, but at the moment, that is a huge part. But I think what is also really exciting, I suppose, within emerging markets, in many ways, a lot of the emerging markets which we're invested in and had sort of leapfrogged, I suppose, the developed market. And when we go traveling, we travel quite a lot as a fund to really kick the tires of the investments that we are investing in. But I find it fascinating. We're in Vietnam, I think back in October, November time. You walk into a restaurant, no cash is required. It's literally a QR code, you're scanning it. And it's going straight forward. So actually, they're in many ways, I think these guys on the digital economy are way ahead of us. And I think, what has come out from the DeepSeek announcement back in January is that, look, these emerging markets can compete with developed markets in the digital sector, providing exactly very, very good quality assets now. And much less the price. Look at the UK. BYD cars. A year ago, they were nowhere to be seen. Now everyone's trying to drive a BYD car, because actually it's technologically better than sort of could be better than Tesla. Don't know. So yeah, there's a lot of trends happening and coming through still, which is I think very positive. But the fund that our fund is invested in a number of these different drivers.
Cool. Inflation's another one. Ross, is it impacting actually when you're looking at new projects? Is there a problem with cost price inflation for actually getting construction stuff done?
To be fair, it's something we've got to have our own internal construction teams, and they're checking on a very regular basis. I think it comes down to, this is the interesting part of the global supply chains at the moment, and what components it's impacting, because the price of solar panels, for example, has still been dropping. You've had a global glut of these, predominantly pushed out by China. And we've actually seen lithium prices coming down quite a lot for battery parts. We work with BYD on the large scale storage, and we know that their prices come down mainly because demand at home dropped off quite a bit during recent. So I think there's a lot going out there, probably with the trade wars, the tariffs, and everything else like that is dampening demand, that has affected some of these components, also power prices to an extent as well. But there's other sort of key components. Transformers have got massive lead times at the moment. Inverters for these sort of things. So it is something we have to look at very closely. I would say it's better than it was a few years ago in the pandemic, when suppliers couldn't even hold their prices from week to week, let alone the usual sort of 2-month period that we're at. But it's definitely something we need to factor in. I think, just as an example, you've seen it in the offshore wind sector. That's the obvious example, and the need that the government has increased the rates for CFD AR7 noticeably. They've reduced the allocation or the strike price for solar, and I think that that's telling. I think that will still support a level of solar build out there, because we can manage it. But you're absolutely right. It's something that we have to look at and monitor very closely. And our teams, we have our internal teams that are in direct supply contact with the suppliers, such as BYD, Cattle, and the solar panel manufacturers as well.
Cool. Okay, thank you.
Can I jump in there, James?
Yeah, of course. Yeah.
Everyone always asks us, how is inflation affecting emerging markets? And I always just smile. Inflation is not a new thing for emerging markets. Management teams, I'm always fascinated. We're in Turkey over the summer, or last summer, and we sit there, we can't understand, huge ridiculous inflation rate levels, and management teams are like, yeah, we're able to manage through this, and they've just learned over the years how to manage it. But also, UEM portfolio itself, a number of the investments we have, again, especially on the utility side, are concession contracts that have automatic inflation pass-through. So therefore, for us, we are sort of very much protected against inflation on that front.
Yeah, I'd just add that it's a similar thing. Most of our contracts, long-term ones, that's infrastructure plays for you. You get an infrastructure inflation linkage on some of the revenue, but also on the costs that's assumed in there.
Yeah. Going to interest rates again. So, Jacqueline, have you got gearing within the trust? And how do you decide when to use it?
Yeah, we have a bank facility, a £50 million bank facility with Barclays. That's in place at the moment. We're, I think, around £17 million drawn, and that's primarily there for us because we're a closed-ended fund. We use it a lot of the time for, I don't know, if there's an IPO coming up, rather than us having to sell something when we may not want to sell it straight away. We can use the funding, or the bank facility, to basically go into that, to basically go into an IPO or something, or a follow-on. But at the moment, we are sort of, I suppose, slightly cautious. where our bank leverage is at the moment. I think because of all the noise we're hearing from Trump coming through at the moment, tariffs, I think once we start to see a little bit more clarity as to where that is coming out, I mean, who knows with Trump as a president whether we'll ever receive any clarity, but we might then look to use that facility. But at the moment, I think we are happy with it at the level that it's at.
And Ross, you were talking about driving down your RCF, but at some point, when does it make sense to use that, do you think?
Yeah, I think just by comparison, I mean, our fund is about 40% geared, really, and we give ourselves, I mean, most of the sector do give renewables sort of ceiling of about 50%. Now, the bulk of that is all in long-term, fully swapped out debt, and that's about 93% of our debt. We then still have we do have a revolving credit facility. So we kick the tires on this and we put the funding in the portfolio level debt, which is generally coterminous with the length of the subsidies, so about another 10 years. That's all fully swapped out at a low rate that we can't get anywhere near in the current market. So that sort of sits where it is. The only variable rate debt that we have in there is the RCF. That's currently about 75 million. We've actually reduced our facility size down from 150 to 75, and that's what we're looking to pay down. What we do have the benefit by investing in different markets and the EU as well. We have a multi-currency facility. So again, it's looking for those differentials. We've swapped about 40 million out of sterling and into Euribor to take advantage of the lower cost of borrowing there. It does come down to that place. There's a few things you can do. I think we'll continue to pay down the debt. It gets to a point of looking at it and saying, are you on a pivot point where the cost of debt is reducing? And it actually, I think it ties up. You've got to look really overall about what the potential returns are. The biggest things, the conversation we're having, and we're having it with investors we have over this week already, is whether you get to that point where the discount narrows so much that your investments again make sense. And that's probably getting it down to around the 10 to 15% discount rate, because we know we could invest in new projects, build them out, and then flip them. You have to look then at whether the cost of debt makes sense and is supportive for that. But I think that's the really interesting point, but where we are just heading into the summer at the moment. If these discounts for our sector do narrow and they can maintain throughout the summer period with lower liquidity, maybe we are in a different environment. But yeah, who knows with the global macroeconomic and things that are coming out at the moment where things can go.
Yeah, cool. Now, I know that discounts are a thing for boards really, rather than managers to manage. But do you have a view as to why your discount arose? And I'm going to start actually with Ross again, if that's all right. Why do you think it opened up, and what is going to fix it, do you think?
Yeah, well, I'll come back to it, and I'll sorry, I think it does circle back to what I was saying earlier about the rapid increase in the Bank of England base rate as well. I mean, the rate at which that shot up, again, the fastest it has in 40 years. And you can see, I don't necessarily think it's all due to that. I think there are differentials in the trust because, as James and I guess the listeners will know well, there is still a range. I think if you look at it, what pushed the whole sector into a discount, I'd say it's still that. It's the increase in the discount rates. Investors, particularly the multi-asset managed funds, the wealth managers and everyone, used to get that really nice spread of about, could be 4, 5, 6, 7% between that and what the real interest rates were. And then you've had the redemptions and everybody pulling money out of the sector. Is it all down to that? No, there are probably specifics down to the funds themselves, issues that they're dealing with, or things such as that. You probably can drive in terms of actually bringing through additional income, being able to demonstrate a clear view of NAV. If you look at some of the funds that have re-rated, you might have a look in the BES space, for example. There has been some consolidation that has helped drive that. We know my colleagues in the private market have taken private Harmony Energy that's sort of added in, but you've also had a bit of a re-rating in revenues in that sector that's playing through. I think people are looking at ourselves and the solar peers have had a bit of a re-rating as well. Obviously, it's a sunny year out there, better than last year. But also starting to see, I think you look at it in solar, we see as less volatile than other technologies as well. So if you want my view on it, I think it's probably 70% the macro, 30% what's down to the individual trusts. What will get you there on that? I think it's going to be, more consolidation, sales of assets at value, And also, it's really down to the investors, and at what point there is a pivot point that they're seeing value in this. And I think our job, you say it's the board's job. We support our board in terms of looking at all options for this and saying, how can we create something that is more attractive to investors in this, so they're not feeling like they have to pull their money out, stick it in gilts or something more safe, that we can actually give them that growth opportunity alongside the yield. That would be my view.
Yeah, thank you. And Jacqueline, so Ross has been through this thing where it wasn't a massive premium, and then it went back to a big discount, and it's coming back again. The UEM discount has been sort of a bit more persistent for a longer time. Do you think there's an element of not a problem, but it is quite a unique trust. It's quite individual. Do you think there's just not enough people know about it or understand it? Is that maybe a part of it? Or do you think it's more just emerging markets and the uncertainty around them that they can't get their heads around?
I think, first of all, it's incredibly frustrating, the discount. We're currently trading at around 11-12% discount at the moment. The investment trust sector as a whole, it's not just UEM, the investment trust sector as a whole is trading at discount. We have seen, if you look at the emerging market investment trust sector, a few months ago, or about 6 months ago, everyone was trading around, about 4 or 5% wider than we are today. There has been a narrowing within the emerging markets. Why? Look, you could argue it's US exceptionalism, as Ross was saying, how much of it's macro driven versus how much is actually performance of the funds. I don't know. UEM, we have unfortunately traded at slightly wider discounts than some of the emerging markets, our emerging market peers. Despite, I would say outperformance and the dividend that we're offering. I think we've bought back around 180 million shares in buybacks, and we paid out 250 million in dividends since inception. So, we're doing all we possibly can at the moment to narrow that discount. We are actively marketing at the moment to try and, I suppose, stimulate more investor interest into the fund, both that be with retail investors and institutional. I do think, at the moment, there's a lot of consolidation going on with a lot of wealth managers as well, which isn't really helping. So yeah, there's a number of factors in play, but all we can do, like Ross doing, is keep performing, and then hopefully the sector will become more favourable in the future.
Yeah. And actually, one of these things about the wealth manager consolidation that we often get is you get headlines for certain brokers and they go like, funds have got to be bigger, funds have got to be bigger.
Mm.
And I never really believed it. Have you ever met an investor that said, I'd love to own your trust, but it's not big enough?
Not that have turned us down for investment, I think,
Yeah.
in terms of that. We haven't heard of anyone literally turning it. Well, we don't know because they didn't invest in the end. But we haven't had many that we've talked to. The prime reason we couldn't invest in you, they always say they would like greater liquidity. I think that's right, and that's where there's quite a bit of push for consolidation within the renewable sector. So I guess the only point out of that, unless you're able to find something that can drive significant synergies. And we think there are potentially opportunities out there. We think our cost base is pretty competitive if you're able to look at it on that perspective. But there's got to be, it shouldn't necessarily just be consolidation for consolidation's sake, because sticking together, you might get a bit more liquidity. One thing that I've noticed is liquidity has really picked up in our trust in the last few weeks, at least. I think people are saying that they'd like to be liquidity greater around 1 million changing hands a day, and we've quite easily had that recently. So I think the narrative could change if things. What's the importance? Is it addressing the discount or is it the liquidity? I think if the discount narrows for a lot of investors, that will help. I think it depends on the size of the trust as well. It's if you're several billion, it's easy. There's been clearly a lot of smaller ones that were too liquid and not had much share. I guess we're kind of in the middle. Wait and see on that. Or again, come back to all you can keep doing is doing your best and delivering on expectations. Okay.
But I think some of those private equity trusts, just to give the example of, you can be £1 billion fund or a multi-billion pound fund and still trade in a big discount. So the size is not the answer necessarily. And Jacqueline, what do you think?
Yeah, no, look, it's really frustrating at the moment, I think. Especially, like I said, I think Utilico offers a really unique investment proposition. We are very differentiated from many emerging market funds. I'm not saying they just track the index, but they're very similar to the index. So we're offering something very different, and we've got performance. And as Ross said, all we can do is keep plugging away and telling our story to a lot of these wealth managers.
Yeah, I think
Certainly.
I'd sometimes get the feeling, James, like you say, and I think it's great analysis that you did earlier in the program, that people, when they're starting to try to do things quite differentiated or different strategies, are they really thinking about the investors? And I've always thought of the listed market as something you're a bit like oil tankers that you need to message quite a long time in advance to make sure that you're bringing your investor base along with you. And I think I'm quite happy with the strategy we've got, but when you're changing from being what was a yield co initially into more of a growth, you need to deliver on that, and people are only going to give you credit for it once you've delivered. Really.
Yeah, cool. Okay, we've covered a lot of sort of big picture stuff. There's some sort of more detailed things here. Just a question with Ross about, do you talk a bit more about power price agreements? How long are they for? And they did vary by market?
Yeah, they vary by market. If you're outside, at a really simple level, historically, the sort of split between our revenue has been about 50% subsidies or other contracted revenues, mainly subsidies in the UK, similar long-term offtake agreements in Australia and Spain. And then the rest, the other half of it, is merchant power that we can either agree to fix or sell. Typically, what we do is forward fix for up to about 3 to 5 years with the offtake providers, or you could put longer term sort of corporate PPAs in there. That's something that we're looking at. It's easier to get corporate PPAs for new build projects, but we are in the process of discussing with a number of off-takers for our operational portfolio as well. But it's that sort of period of around probably the next 3 to 5 years where we're looking to forward fix with the offtake agreements.
Okay, cool. Jacqueline, the question here is about currencies. It's actually talking about currency manipulation, but I suppose, how do you factor currency movements within emerging markets into your investment decisions? And do you ever try and hedge exposures?
Yeah, I mean, look, currency is something that we always get asked by investors on. Look, we don't hedge the currencies, but primarily because it's too costly for us to do so. So it's not something that we've ever done. But over time, I mean, last year the Brazilian real was a little bit of a headwind for us. This year, it's we've seen the opposite. So over time, it sort of pans out as such. I mean, currency also gets factored into sort of our valuation process. I mean, obviously, it affects the discount rates at which we're applying, because the risk premium that we're adding to these investments. So there is a sort of a built-in currency factor in there. But yeah, at the end of the day, we are exposed to the FX risk. I would say though that it was frustrating last year for us in Brazil, for instance. I mean, there was a depreciation of the Brazilian real about 16% over the year. But actually, if you looked at the underlying performance on the local stock exchange of the companies that which we invest in, I mean, some of them are up 40-50% over the year in local currency terms. So just shows you how all these companies are outperforming despite, the macro picture there on the FX side. So yeah.
Yeah, great. Thank you. I think we actually covered most of this stuff now, but there's a general question about activist investors. I'd sort of put my two pennies in before maybe you chime in, but I think the boards recognise that you have to treat all shareholders, regardless of their agenda, with sort of respect and fairly. Do you think that there's a danger that some trusts sort of dance to the tune of active investors a bit more than they should do, or do you think that they are serving a useful role and worth listening to?
Do you want me to go first on that one?
Yeah, go on then.
I think I wouldn't necessarily say we've got many. I don't want to typecast anyone the wrong way, but highly activist investors now. But I think we've had some very vocal ones over the last couple of years who got strong views around things. And I think there is a tendency that those that shout the loudest do tend to get heard more often, especially if they're demanding cause. I think it's one thing in terms of the activist investors, and specifically, we know there are some activist funds that have raised to look at an alternative sector. I do think the board's being very open to listen to all shareholders is very important. And I do think we've got a board now with our outgoing chair and incoming chair and the additions and changes that we've made that have been very clear that they will act in shareholders' best interests and have been actively out there looking to do things. And I think that is the best protection to actually against the argument of actually having activist investors. Because if you've got an activist investor trying to drive something, either they've got a point that people don't necessarily agree with, or that the board's not doing its job. So I think it is important to listen to everybody, but it's also for our fund, we do investor engagement surveys and things like that. You need to make sure that you're listening to everyone, including what can be sometimes the silent majority.
Yeah, I would totally echo what Ross is saying there. I mean, most of you know we've got Saba on our register at the moment, just over 5%. They came onto the register at the end of May. And all we can keep doing is performing and doing what we're doing. We're as a manager, and that is what we're focused very much 100% on at the moment. We also have a new chairman, primarily because the old chairman, had got his 9-year tender and rolled off, and our new chairman is all speaking to all shareholders at the moment, not just the more activist ones. And as like Ross said, just not as he shouts loudest, but it's also listening to the quieter shareholders, that have been long-term investors that really believe in the value of the fund and want to continue to be invested in the fund. So it's trying to balance up all investors or all shareholders' interests.
Cool. I'm conscious of time, so just maybe 1 minute each. Could you just tell me why you think an investor, you might be a good investment now? Ross first.
Well, yeah, I think it comes back to that point. I think if you look at it even today, even with the re-rating that the fund has had, which I think is positive and a bit for the sector as well, you can still buy the shares at a 9% yield, and we're looking to give growth on top of that. And that 9% yield is covered by a portfolio that the majority of it has been in operation for 12 years now. We know incredibly well and is incredibly reliant. So that, in terms of the dividend cover of the fund, we're very confident about that. I'd also say look at some of the announcements in terms of that growth story. We've got development projects in Spain coming through now. We've got around 150 megawatts between solar and BESS that we've got coming into that. I mean, it will probably take another year for those to get ready to 6 to 12 months for those to get to ready to build stage, but we could either sell those hopefully at a premium, or if things have changed, we could start to recycle some capital into building out those new opportunities. So we're focused on the yield and we're focused on the growth as well, and hopefully view us as a good buy currently.
Yeah, and UEM, look, we've been trading now 20 years. We've got a very strong 20-year track record. We're investing in assets that we believe that are still trading at very compelling valuations. I mean, the UEM fund, as you know, is trading at 11-12% discount. We're offering a 3.7% dividend yield on top of that. It's also a very resilient portfolio and offers investors a very different sort of differentiated product away from just another emerging market investment trust. The team also, I think we've got over 100 years experience between us. We've been following a lot of I've been with the fund now for 15 years, been following a lot of these companies over the period of time. And we'll just continue to try and deliver and achieve the highest return we can for our shareholders going forward.
Brilliant. There we go. So thank you very much for your time today. Thank you very much for everybody that tuned in. And we'll obviously follow with interest. Good luck with it all. I do think both of you actually are interesting funds, and both of you, the discounts are probably unjustified. So good luck with it all, and we'll talk to you again soon.
Thanks, James. Been a pleasure. Thanks.
Cool. Next week, I'll be back talking to Richard Pinder from Literacy Capital, and obviously Andrew Mahati will be here because it'll be the first Friday in the month. So he'll be talking about what happened over the course of July. So please do have a good weekend, and I will see you next week.